If you think getting rich comes down to finding the right stock, the right coin, the right hot tip before everybody else does, I need you to stop right there because that belief will keep you broke for the rest of your life. I have sat across the table from geniuses, people with more raw intelligence than I will ever have, and I have watched them lose everything because they were addicted to being right instead of addicted to protecting what they already had. And on the other side, I have watched completely ordinary people, people who never picked a single hot stock in their life, build real, lasting generational wealth because they understood one thing almost nobody ever teaches you. It is not about what you buy. It is about how you think. Today, I'm going to hand you the actual mindset, not the hacks, not the shortcuts, the real thing that separates people who build wealth for 40 years from people who get lucky for 1 year and lose it all in the next. And I promise you, none of what I am about to say involves a secret strategy, a special account, or some product you need to go buy. It is entirely about the 6 inches between your ears, and it is the part of investing that almost nobody wants to talk about because it is not flashy enough for a headline. Before I go any further, I have to say this clearly. What I am about to walk you through took me decades, a handful of painful losses, and a lot of swallowed pride to actually learn. Most people end up paying for these lessons the hard way, with their own money, in real time, when it is way too late to do anything about it. I am handing it to you for free right now, but I need one thing from you first. Subscribe before you keep watching, because I build directly on every single one of these ideas in the next video, and I am not going to repeat myself for people who skip this part. So let's start with the mistake that ends more financial futures than any market crash ever will, and that is falling in love with being right. Most people who lose money in markets or in business do not lose it because they made one bad decision. They lost it because they made a decision to it started going against them. And instead of admitting that, they dug in deeper. They started hunting for reasons that justified what they already believed instead of honestly looking at what was actually happening right in front of them. I want you to really sit with that for a second, because it might be the single most expensive habit in all of investing. Your ego does not care one bit about your bank account. Your ego just wants to be right. And the market does not care one bit about your ego. It will happily take your money for years while you sit there defending a position that everybody around you can see is wrong. Here is the shift you have to make in your own head. Stop asking yourself, am I right? Start asking yourself, what is actually happening right now? And knowing what I know today, would I do this again from scratch? That second question is brutal because it strips away all your emotional attachment to the past. If you did not already own this stock, this house, this business, would you buy it today at this exact price with everything you now know? If the honest answer is no, then the fact that you already own it changes absolutely nothing. The facts do not care how long you have held something, how much money you already put in, or how many times you told your friends how great this was going to be. I made this exact mistake early in my own career, holding on to a position purely because admitting I was wrong felt worse than losing more actual money, which tells you everything about how backwards our instincts get once real money is on the line. The people who build lasting wealth are not the ones who are right the most often. Nobody is right that often, not even close. They are the ones who lose the least when they are wrong, and that only comes from being willing to say out loud, I was wrong, faster than anyone comfortable around you would like. Let me give you a way to actually catch yourself doing this. Because knowing about ego is not the same as noticing it in real time while it is happening to you. Pay attention to the language you use in your own head about a position that is going against you. If you find yourself saying things like, it will come back, or I just need to give it more time, without any new information backing that up, that is not analysis anymore. That is hope wearing a suit. Hope is not a strategy and has never once been a strategy for anyone who kept their wealth over the long run. There is a simple test I have used for years to catch myself before I fall into this trap. I imagine explaining the position to a stranger who knows nothing about my history with it, no idea how long I have held it, no idea how much I have already lost or gained. If that stranger, hearing only the current facts, would tell me to get out, then the only thing keeping me in is my own attachment to the past, not anything real happening in the present. The professionals who last decades in this business have a strange habit that looks almost cold from the outside. They can hold a strong opinion and completely abandon it within the same week if the facts shift, without any embarrassment at all. Most amateurs treat their opinions like they are part of their identity, so changing their mind feels like losing an argument. Treat your opinions like tools instead, useful right up until the moment they stop being useful, and then you set them down, without any guilt whatsoever. Now, here is where most people get the next part completely backwards, and it quietly costs them for the rest of their financial life. They think smart investing means spreading your money out evenly across everything so nothing can really hurt you too badly. Sounds safe, right? It is actually one of the slowest, most mediocre ways to build real wealth that exists. Real wealth gets built by understanding the difference between a coin, flip, and an actual opportunity. And almost nobody sits down and honestly sorts their ideas into those two buckets. Most of what crosses your path in investing is close to a coin flip. Maybe it works out, maybe it does not. And honestly, you cannot tell the difference in advance, no matter how confident you sound while explaining it to your friends. But every once in a while, and I mean rarely, genuinely rarely, you come across something where the odds are stacked meaningfully in your favor. Maybe it is a business, you understand, because you have actually worked in that exact industry for years. Maybe it is a moment where fear has pushed a great asset down to a price that has nothing to do with its real underlying value. When that happens, and again, it does not happen often, that is not the moment to place a small, cautious, spread out bet just to feel diversified. That is the moment you size up, and you size up meaningfully. Real conviction is rare, and when you actually have it, playing it small and safe is functionally the same as not having conviction at all. The mistake most people make is the exact opposite of this. They go small in the handful of ideas they actually understand deeply, and they go big on random stuff they barely research just because someone online sounded confident about it exploding. Flip that entirely around. Be timid on your coin flips and be aggressive, genuinely aggressive, on your rare high conviction opportunities, and know clearly which category you are in before you put a single dollar to work. That distinction alone, knowing when you actually have an edge versus when you are simply gambling and dressing it up as investing, is worth more over a lifetime than any individual stock pick I could ever hand you on this channel. I want to be really clear about what real conviction actually looks like because people misuse that word constantly. Real conviction is not a feeling of excitement. Excitement is cheap and it fades in a week. Real conviction is when you can explain out loud, in plain language, exactly why the odds are in your favor, without using a single word you do not fully understand yourself. If you cannot explain your reasoning to a 12-year-old in 2 or 3 sentences, you probably do not actually have conviction. You have a story you picked up from somewhere else and adopted as your own. This is also why most people never experience a real high conviction opportunity more than a handful of times across their entire life. And that is completely normal. It should feel rare because it is rare. The danger is manufacturing false conviction out of boredom, because sitting on your hands waiting for a real opportunity feels unproductive, even though it is often the most productive thing you can possibly do with your capital. Boredom is genuinely one of the most underrated threats to your money that exists because it does not feel dangerous the way fear does. It feels like nothing, and doing something, anything, starts to feel better than doing nothing, even when doing nothing is exactly the correct move. Learn to sit in that discomfort without turning it into activity just for the sake of feeling productive. Let's talk about something nobody wants to hear in a world obsessed with fast gains, which is that protecting what you already have matters more than growing it further. I know that sounds boring next to stories about doubling your money in a month, but walk through the actual math with me for a second. If you lose 50% of your money, you do not need a 50% gain to get back to even. You need a full 100% gain just to break even. And that is before you even get back to actual growth. That math is brutal, and it is exactly why the people who survive decades in markets are obsessed, and I mean genuinely, quietly obsessed, with not taking the one big loss that wipes them out completely. It is not that they never lose money. Everybody loses money sometimes. That is simply the cost of playing this game at all. It is that they never let one bad decision take them off the board entirely. I want you to think about your capital like it is the oxygen supply for your entire financial life. Your first job, before anything else, is to make sure you always have enough oxygen left to keep playing the game. Tomorrow, growth is what you get to chase after. You have already made absolutely sure you survive. Most people flip that order completely. They chase growth first and they treat survival like an afterthought, some minor detail they will worry about later. And that is exactly why so many people who looked like they were crushing it for a year or two end up with basically nothing 5 years down the road. One bad year does not ruin anyone with a real plan. One catastrophic account wiping mistake absolutely does, and it usually comes from ignoring this exact principle. So before you ever ask yourself, how much money could I make on this? Ask yourself first, if I am completely wrong about this, what does my actual life look like on the other side of that? If the honest answer is that you are fine, a little poorer maybe, but genuinely fine, then you are playing this game the right way. If the answer is that you are wiped out entirely, then you have already lost, regardless of whatever the price does next, and you need to size that position down before you do anything else. There is a version of this rule that applies just as much to your daily life as it does to your portfolio, and people miss it constantly. Protecting what you have is not only about avoiding a bad trade, it is about avoiding lifestyle decisions that quietly increase how much oxygen you are burning through every single month. Because the more you spend to simply exist, the less room you have to absorb a bad year without panicking and making an end-of-year emotional decision at exactly the wrong moment. I have watched people with genuinely strong incomes end up more fragile than people earning a fraction of what they made, purely because their monthly obligations left them no room to breathe when something unexpected happened. Real financial safety is not a specific number in an account. It is the gap between what you actually need to survive and what you actually have available. And the wider you can keep that gap, the more calmly you get to make every single decision that follows. Because panic is where almost all the worst financial decisions in history were born. I have also noticed that people confuse net worth with staying power, and those are not the same thing at all. You can be worth a great deal on paper and still be one bad month away from being forced to sell something valuable at the exact worst possible time, simply because too much of what you own cannot be turned into cash quickly without taking a loss. Staying power means you get to choose when you sell instead of being forced into it by circumstances outside your control. That single freedom, the ability to wait out a bad stretch on your own terms instead of someone else's, is worth more than almost any return you could chase, because it is the difference between a temporary setback and a permanent one. Here is where the real mindset separates from absolutely everything else you will hear online. And it has nothing to do with charts, headlines, or any hot take of the week. It is patience, but not the lazy kind of patience where you just do not check your account for a while and call that discipline. It is active patience, where you are doing real work behind the scenes while you wait, staying sharp, staying informed, staying ready. And then when the actual moment shows up, you move with real conviction instead of freezing up or hesitating. Most people treat building wealth like it is a sprint, mostly because that is exactly what social media makes it look like. Somebody flashes a screenshot of a trade that jumped 40% in a week, and suddenly everyone watching thinks that is what building real wealth actually looks like. It is not even close. Real wealth is genuinely boring in the middle stretch. It is years of holding good, quality assets while nothing exciting seems to be happening, while your account barely moves month to month, while it feels like everyone else online is somehow getting rich faster than you are. And then, often without much warning at all, years of quiet patience compound into results that look almost impossible from the outside, but were completely predictable from the inside the whole time. If you actually understood what you were holding and why you were holding it. The traders who are constantly in and out always chasing whatever is hot this week. They might have a spectacular month here and there that they love to talk about. But stack 10 full years of that behavior side by side against someone who simply owned quality and let time do the heavy lifting. And honestly, it is not even close. The compounding does not happen because you were brilliant every single day. It happens because you did not interrupt it out of boredom, impatience, or fear. Here's the part almost nobody tells you about patience, and it is the part that actually makes it hard instead of just sounding wise on a poster. Patience is only easy when nothing is happening. It becomes almost unbearably difficult the moment your quality asset drops for reasons that have nothing to do with why you bought it in the first place. That is the exact moment most people abandon a perfectly good decision, right before it was about to pay off, simply because staying the course felt lonelier than reacting to the noise around them. The people who actually build wealth over decades have trained themselves to ask one specific question whenever something drops hard, and it is this: has anything actually changed about the reason I own this in the first place, or has only the price changed? Those are two completely different situations that require two completely different responses, and confusing them is one of the most common and most expensive mistakes an otherwise smart person can make. Last thing, and this might genuinely be the most important point of everything I have told you today: stop outsourcing your thinking to the crowd around you. When everyone around you is saying the exact same thing with total, unshakable confidence, that is precisely when you need to slow down the most, not speed up to keep pace. Crowds are not always wrong. Let me be clear about that. But crowds are the most dangerous, exactly at the moment. They feel most certain, because that certainty usually means almost everyone who is ever going to buy in has already bought in, and almost everyone who is going to sell has already sold. So the best decisions I ever made, in my own experience, showed up when I was genuinely uncomfortable, when what I was doing looked a little foolish, maybe even a little embarrassing to the people around me at the time. And the worst decisions I ever made were the ones where I felt completely safe because everyone I knew agreed with me that discomfort is not some flaw in the process. It is basically the entry fee for actually finding value that other people have not found yet. Because the moment everyone sees it, the opportunity is usually already gone. Now, this does not mean to be contrarian just for the sake of feeling clever. That is exactly as dumb as blindly following whatever the crowd is doing. It means do your own real thinking. Form your own honest view based on what is actually true right now. Hold that view even when it is deeply unpopular. And just as important, be willing to drop it the very second the underlying facts genuinely change, no matter what anyone else around you still happens to believe. I think the reason this is so hard for people has nothing to do with intelligence and everything to do with belonging. Humans are wired to want to agree with the group. It feels safe, it feels social, it feels like protection. But markets do not reward safety in numbers. They reward being early to something true before it becomes obvious to everyone else. And by definition, being early means looking wrong to almost everybody around you for a while. If you need constant validation from other people to feel confident in a decision, you will always be arriving right as the real opportunity is leaving. Build the habit now, while the stakes are smaller, of sitting with an unpopular but well-reasoned opinion without needing anyone else to agree with you out loud. That single skill, more than any spreadsheet or strategy, is what actually separates people who compound wealth over a lifetime from people who simply follow whatever everyone else happens to be doing that particular year. So here is your challenge. And I actually want you to do this, not just nod along and close out the video. Go look back at your last 3 real financial decisions, whether that was a stock, a purchase, a business call, anything with real money attached to it. For each one, ask yourself honestly, did I make that decision because the facts genuinely supported it, or because I simply did not want to admit that I was already leaning in a different direction before I even looked at the facts? That one question will tell you more about your actual relationship with money than any book or video ever could. Real wealth is not built by people who are smarter than everyone else around them. It is built by people who are more honest with themselves than everyone else, who protect what they already have first, who size their bets according to real conviction instead of noise and hype, and who have the patience to let time actually do its job without interference. None of that requires a genius level IQ, a finance degree, or some insider information the rest of us do not have access to. It requires discipline. You build one decision at a time, usually in moments nobody else is watching, which is exactly why so few people actually stick with it long enough to see the results. If any of this changes how you think, even a little bit, share it with someone in your life who genuinely needs to hear it. And I will see you in the next one.